What if I told you that one of the most powerful banks in the world has shaped wars, crises, and even your daily life without you ever noticing? This is the untold story of Bank of America. From its humble beginnings to its rise as a global financial titan, surrounded by scandals, bailouts, and power struggles that still affect you today. Stay with us till the end of this documentary to uncover the truth behind the world's most controversial bank. And if you want more powerful stories like this, don't forget to subscribe to Zimo Voice and join our community of curious minds. It begins with a man, not a corporation. A man of humble origins, born into an Italian immigrant family in California, who would eventually shape the destiny of one of the largest financial institutions the world has ever seen. His name was Amedeo Pietro Giannini. To many, he was simply a grocer, the son of immigrants, an ordinary man in an America that often treated newcomers with suspicion and disdain. Yet, within him lived a vision, one that would alter the course of banking forever. At the turn of the 20th century, California was a land of promise, but also of exclusion. Immigrants, especially Italians, were often shunned by mainstream banks. They were deemed untrustworthy, too risky, and in many cases simply unworthy of credit. Giannini saw this injustice firsthand. He recognized not only the prejudice, but also the opportunity hidden within it. If no bank would lend to these hard-working families, then perhaps he should. In 1904, Giannini founded the Bank of Italy in San Francisco, an institution unlike any other at the time. It was not designed for the wealthy elite, nor for industrial magnates or established aristocrats. It was designed for the working class, immigrants, shopkeepers, farmers, laborers. Giannini believed that banking was not a privilege reserved for the few, but a service that could uplift the many. He lent money to those others considered unworthy, and in doing so, he not only built loyalty, but also laid the foundation of a banking empire. When the Great San Francisco earthquake struck in 1906, devastation followed. Fires consumed much of the city. Businesses collapsed and lives were shattered. In this chaos, Giannini's vision was put to the test. While other banks kept their vaults closed, fearing looting and destruction, Giannini salvaged his deposits and records, hiding them under piles of fruit in a borrowed wagon. From the streets, he set up makeshift banking operations on a wooden plank, lending money to residents desperate to rebuild their homes and businesses. This act of daring and compassion did not just save livelihoods, it cemented his reputation as a banker of the people. Over the years, the Bank of Italy grew, fueled by California's booming economy and the trust Giannini had built among its citizens. By the 1920s, the bank had become a major force on the West Coast. Through strategic mergers and relentless expansion, Giannini's creation transformed. In 1928, the Bank of Italy officially changed its name to a far more ambitious one, Bank of America. From the beginning, Giannini dreamed of creating a financial supermarket. A bank not only for deposits and withdrawals, but also for mortgages, auto loans, insurance, and investments. It would be a place where the average American family could find every financial service under one roof. This vision was revolutionary. While banks on the East Coast, like J.P. Morgan and Citibank, focused on the wealthy elite and large corporations, Bank of America became the bank of the middle class. By the late 1920s, Bank of America had amassed over $1 billion in assets, a staggering sum for the era. It had become the largest bank in the United States, a title that carried both prestige and responsibility. When the Great Depression struck in 1929, many banks across the country collapsed under the weight of failing loans and runs on deposits. But Bank of America endured, thanks in large part to Giannini's cautious yet innovative strategies. Where others faltered, he expanded, offering credit to farmers, small businesses, and ordinary families when they needed it most. This resilience allowed the bank to grow even stronger during one of the darkest chapters in American economic history. By the 1930s and 40s, Bank of America had entrenched itself as a pillar of stability on the West Coast. Giannini's reputation as a man of the people had become legend. He had given credit to those who built homes, funded small shops, and planted crops. He financed Hollywood when the film industry was just beginning, helping to transform Los Angeles into the movie capital of the world. In many ways, Bank of America was not just a bank. It was a driving engine behind the growth of modern California. But Giannini was not content with regional success. He envisioned Bank of America as a truly national, even global institution. His successors carried that torch, expanding the bank's footprint across the United States. By the 1950s, under leaders like S. Clark B's, Bank of America had become a household name. It was no longer just a bank for Italian immigrants in San Francisco. It was a financial empire serving millions across the nation. In the post-war era, America was booming. The middle class was expanding. Suburbs were rising and consumer culture was flourishing. With prosperity came credit. And Bank of America was at the forefront of this transformation. In 1958, the bank launched one of the most ambitious experiments in American banking history, the Bank AmeriCard. It was the world's first general-purpose credit card, mailed out to tens of thousands of households in Fresno, California. The idea was radical. Give ordinary citizens instant access to credit without requiring lengthy applications or personal interviews. At first, the program was chaotic. Fraud soared, defaults skyrocketed, and the bank lost millions. But over time, the credit card system was refined, and what began as a Bank AmeriCard evolved into something far greater, Visa. Though Visa eventually separated from Bank of America, its roots remained tied to a bank that dared to think differently. By the 1970s and 80s, Bank of America had firmly established itself as one of the largest financial institutions in the world. Its reach extended into nearly every sector of the economy. It funded corporate giants, supported governments, and played a key role in global finance. Yet with size and power came scrutiny. The bank was no longer just a community lender. It was a titan, a symbol of corporate America's influence on everyday life. The story of Bank of America is not just about growth and success. It is also about crises, bailouts, and the uneasy relationship between Wall Street and Washington. In the decades to come, this bank will become a central player in some of the most dramatic financial episodes in American history, from the savings and loan crises to the mortgage meltdown of 2008. And each time, the same question would emerge: how much power should one bank wield, and at what cost to society? By the dawn of the 1980s, Bank of America stood as one of the largest banks not only in the United States, but in the entire world. With its vast network of branches, billions in assets, and influence stretching across industries, it had become a symbol of American financial might. But the very scale that had made it powerful also made it vulnerable. Banking in the late 20th century was becoming increasingly complex, with new regulations, rapid technological changes, and global competition testing even the strongest institutions. During this era, the bank pursued aggressive growth strategies, seeking to expand beyond traditional banking services. It ventured into international markets, acquiring banks abroad, and sought to capture new streams of revenue from corporate lending and investment banking. The idea was simple. If Bank of America was to remain a global leader, it could not simply rely on California mortgages and small business loans. It had to compete on the world stage with giants like Citibank, JP Morgan, and Chase Manhattan. But expansion often comes at a cost. In the late 1980s, Bank of America found itself overextended, struggling with losses from risky international loans, particularly to Latin American countries facing debt crises. The optimism of global expansion collided with the harsh reality of defaulting borrowers and economic instability. By the early 1990s, the bank faced severe financial difficulties, and whispers began circulating in the financial world. Could Bank of America actually collapse? The institution that had once been a lifeline for immigrants and small businesses was now struggling to manage its own survival. Analysts predicted layoffs, asset sales, and restructuring. Critics argued that the bank had strayed too far from Giannini's original vision, chasing profit abroad while forgetting the stability of its roots. In those years, rivals gained ground, and for the first time in decades, Bank of America's dominance seemed uncertain. But banking is as much about perception as it is about numbers. A bank's power lies not only in its balance sheet, but in the public's trust. Bank of America's leaders understood this and moved aggressively to stabilize the institution. In 1998, a major merger with Nations Bank transformed the landscape. Overnight, Bank of America became the largest bank in the United States, with a massive presence from coast to coast. The deal created a powerhouse that dwarfed its rivals, putting the Bank of America name at the center of American finance once again. This merger also reflected a larger trend sweeping the industry: consolidation. As the 20th century drew to a close, banks were getting bigger, more powerful, and more deeply intertwined with the daily lives of ordinary citizens. Bank of America was no longer just a regional bank or even a national one. It was a global behemoth, managing trillions in assets, processing millions of transactions daily, and influencing economies far beyond U.S. borders. In the early 2000s, the bank expanded further, acquiring firms like Fleet Boston and MBNA, the latter being one of the largest credit card issuers in the world. This acquisition gave Bank of America an enormous foothold in consumer credit, adding millions of new customers to its already massive base. By the mid-2000s, it seemed unstoppable. Its name was emblazoned on skyscrapers. Its branches covered nearly every major city, and its influence touched everything from mortgages and credit cards to global corporate deals. But beneath the surface, trouble was brewing. The early 2000s also marked the rise of the subprime mortgage industry. Banks across America, including Bank of America, began issuing risky loans to borrowers with poor credit histories. These loans were then bundled into complex financial products, mortgage-backed securities, that promised investors steady returns. For a while, it seemed like a golden era of endless profit. Housing prices soared, borrowers took on ever larger debts, and Wall Street cheered. Bank of America, like its peers, dove deep into this business. The profits were irresistible, and executives assured investors that the risks were minimal. But as the world would soon discover, those assurances were built on sand. By 2007, cracks began to appear. Borrowers started defaulting on their mortgages at alarming rates. The supposedly safe securities tied to those loans began to unravel. What followed was one of the greatest financial crises in modern history. When the 2008 financial crisis hit, Bank of America was at the center of the storm. In a desperate attempt to stabilize the system, the bank acquired the troubled mortgage lender Countrywide Financial, one of the largest players in subprime loans. On paper, the deal was meant to solidify Bank of America's dominance in the mortgage market. In reality, it saddled the bank with billions in toxic assets, lawsuits, and endless controversy. As if that weren't enough, in the same year, Bank of America also acquired Merrill Lynch, the once iconic investment bank, as it teetered on the edge of collapse. The deal was pushed forward under immense government pressure, with regulators fearing that Merrill's failure would trigger a total financial meltdown. For Bank of America, it was a moment of both heroism and disaster. On one hand, it had absorbed two collapsing giants, helping to prevent the financial system from completely imploding. On the other hand, it had inherited billions in liabilities and placed itself in the crosshairs of public outrage. The government stepped in with massive bailouts, injecting billions of taxpayer dollars into Bank of America to keep it afloat. For ordinary Americans who had lost their job, their homes, and their savings in the crash, this was infuriating. While families struggled, the very banks that fueled the crisis were being rescued with public money. And few banks symbolize this paradox more than Bank of America. The name that once represented opportunity for immigrants now became, for many, a symbol of corporate greed and government favoritism. Protesters targeted Bank of America branches. Politicians denounced its practices, and lawsuits piled up. The bank paid tens of billions in settlements over the following years, covering everything from faulty mortgages to securities fraud. Yet despite the backlash, despite the fines, despite the public anger, Bank of America survived. It was too large, too interconnected, too important to fail. The very size that once seemed like a weakness had become its greatest strength. By the 2010s, it stabilized, repaid government loans, and returned to profitability. But the crisis had changed it, and not just Bank of America, but the entire banking industry. Regulations tightened, oversight increased, and new debates emerged about the role of megabanks in modern society. Should any one institution be allowed to wield such immense power? Should taxpayers ever again be forced to bail out corporations? These questions remain unresolved, and Bank of America remains at the center of them. Today, Bank of America stands as one of the largest financial institutions on earth, managing trillions in assets, serving millions of customers, and influencing the global economy in ways both visible and invisible. Its history is one of triumph and scandal, of innovation and controversy, of resilience and criticism. From the humble vision of Amedeo Giannini to the skyscrapers of Wall Street, the story of Bank of America is the story of modern finance itself, a story of power, ambition, and the delicate balance between profit and responsibility. And yet, this story is far from over. Because as long as money flows, as long as crises emerge, and as long as power accumulates in the hands of few, Bank of America will continue to shape not only the financial system, but the very lives of millions across the globe. The financial crisis of 2008 left scars on the reputation of every major American bank. But for Bank of America, those scars were especially deep. Its high-profile acquisitions of Countrywide and Merrill Lynch were meant to showcase strength, but in the years that followed, they became cautionary tales. Lawsuits flooded in, regulators demanded answers, and shareholders questioned whether the bank's empire was built on solid ground or on shifting sands. Between 2010 and 2014, Bank of America paid out staggering sums in legal settlements. Billions of dollars vanished in a storm of litigation tied to toxic mortgages, foreclosure practices, and securities fraud. At one point, the Department of Justice announced the largest civil settlement with a single company in American history. Bank of America agreed to pay nearly $17 billion to resolve claims related to mortgage crisis. For critics, this was confirmation that the bank had been a central architect of the financial collapse. For supporters, it was a necessary penance, a way to finally close a chapter on a dark past. But even as it fought these legal battles, Bank of America was undergoing a transformation under the leadership of CEO Brian Moynihan, who took the helm in 2010. The bank pursued a strategy of retrenchment and stability. Gone were the days of reckless acquisitions and unchecked risk-taking. Instead, Moynihan focused on simplifying operations, cutting costs, and rebuilding trust. He sold off non-core assets, reduced the bank's global footprint in some areas, and emphasized serving households, small businesses, and corporations with a focus on transparency and efficiency. This shift was not glamorous, nor was it universally praised. Some investors complained that Moynihan was moving too slowly, that the bank was not growing aggressively enough compared to rivals like J.P. Morgan Chase or Goldman Sachs. But for Moynihan, survival came before ambition. Bank of America needed to prove to regulators, investors, and the public that it could be a responsible steward of capital. In the early 2010s, the bank also embraced technology in a way that reflected the changing habits of its customers. Mobile banking apps, online account management, and digital payment systems became central to its strategy. For millions of Americans, Bank of America was no longer a marble lobby or a towering skyscraper. It was an icon on a smartphone, a digital interface that allowed bills to be paid, checks to be deposited, and transfers to be made with a swipe of a finger. This transformation into a digital-first bank helped it reduce costs while maintaining relevance in an era when fintech startups were threatening to disrupt the traditional banking model. By the mid-2010s, the strategy began to pay off. Earnings stabilized, legal troubles slowly diminished, and the bank's stock price recovered. Investors who had once feared collapse now saw Bank of America as a stable, if somewhat conservative, institution. Its balance sheet was stronger, its risk profile lower, and its public image, while still tarnished, began to mend. Yet, controversies never fully disappeared. Critics continued to accuse the bank of predatory lending practices, discriminatory behavior, and excessive fees. Whistleblowers alleged misconduct, and watchdog groups argued that despite reforms, the fundamental culture of big banking had not changed. For many ordinary Americans, Bank of America was not a savior or a symbol of opportunity. It was still a giant that profited while families struggled. Globally, however, the bank's influence only expanded. With clients in over 35 countries, it became a financial bridge between continents, facilitating trade, investment, and capital flows on an unprecedented scale. Corporations turned to Bank of America not only for loans, but for complex financial services that span mergers and acquisitions, currency trading, and global markets. In many ways, the institution had become more than just a bank. It was a global financial infrastructure, as essential to the world economy as the internet is to communication. As the 2010s drew to a close, a new challenge emerged. Public perception. Millennials and younger generations, scarred by the financial crisis, were skeptical of big banks. Movements like Occupy Wall Street had already painted institutions like Bank of America as villains. To remain relevant, the bank had to craft a new identity. It began marketing itself not only as a financial partner, but as a socially responsible corporation. Campaigns emphasized sustainability, diversity, and community investment. Billions were pledged toward renewable energy projects, affordable housing initiatives, and local development. The message was clear. Bank of America wanted to be seen not just as a machine of profit, but as a force for good. Then came the 2020s, a new decade, and with it, new upheaval. The COVID-19 pandemic brought the global economy to its knees. Businesses closed, unemployment soared, and uncertainty rippled through markets. For banks, the crisis was a test. Would they once again rely on government bailouts, or would they stand as pillars of support? For Bank of America, the pandemic became an opportunity to prove its resilience. It facilitated billions in loans through government programs like the Paycheck Protection Program, helping small businesses survive. It offered relief to customers struggling with mortgages and credit card debt. Its digital platform surged in usage as millions avoided branches and turned instead to mobile banking. Financially, the bank weathered the storm. Unlike 2008, this crisis did not bring it to the brink of collapse. Instead, it emerged stronger, with record profits in the years that followed. For some, this was proof that the reforms of the past decade had worked, that the bank had learned its lesson and rebuilt on firmer ground. For others, it was yet another example of how the largest institutions always find a way to thrive, no matter the circumstances. By 2023, Bank of America managed over $3 trillion in assets and had become one of the largest employers in the financial sector, with hundreds of thousands of employees worldwide. It was not only an American bank, but a global powerhouse, integrated into the very structure of international finance. Yet questions remained. Could any institution of this size truly act responsibly? Was Bank of America still guided by Giannini's vision of serving the common person, or had it become a faceless giant serving only shareholders and executives? The debate rages on, with critics and offenders offering starkly different views of its role in society. What cannot be denied is its influence. From mortgages and credit cards to global markets and government bonds, Bank of America's presence is felt in nearly every corner of the financial world. Its decisions ripple outward, affecting not only Wall Street investors, but also families in small towns, entrepreneurs in developing countries, and governments managing national economies. In the story of Bank of America, we find a paradox. A bank that began as a lifeline for the poor now commands the heights of global finance. An institution that once embodied generosity and trust now symbolizes power and controversy. A name that evokes both opportunity and anger, stability and scandal, resilience and greed. The story is far from finished, because as history shows, every era brings new crises, new opportunities, and new reckonings. And wherever money flows, whether in times of prosperity or despair, Bank of America will be there, shaping, influencing, and redefining what it means to hold power in the modern world. To understand Bank of America's modern identity, one must look beyond balance sheets and financial statements, and instead examine the long trail of controversies and scandals that have shadowed its rise. For every story of growth and resilience, there is another of lawsuits, investigations, and accusations that reveal the darker side of banking power. In the years after the 2008 financial crisis, Bank of America became one of the most heavily scrutinized institutions in the world. Its acquisition of Countrywide Financial, once seen as a bold strategic move, turned into a disaster that haunted the bank for more than a decade. Countrywide had been one of the largest issuers of subprime mortgages, loans given to borrowers with poor credit histories, often with little verification of income or assets. When the housing bubble burst, these loans defaulted en masse, leaving devastation in their wake. For Bank of America, the consequences were staggering. Waves of lawsuits accused the bank of misleading investors, defrauding customers, and fueling the housing crisis. Government regulators demanded accountability. State attorneys general filed actions. Class action suits multiplied. The bank became a lightning rod for public anger, seen by many as a symbol of corporate recklessness that had nearly destroyed the global economy. The legal settlements added up to tens of billions of dollars, making Bank of America one of the most fined financial institutions in American history. The $17 billion deal with the Department of Justice in 2014 was not just a number. It was a reminder of the scale of damage inflicted by the mortgage crisis and of the cost society had to bear. Yet even these penalties did not erase the lingering resentment among ordinary Americans who had lost their homes, savings, and stability while banks survived and even thrived with government support. But lawsuits were not confined to mortgages. Over the years, Bank of America faced allegations of discriminatory lending practices, charging higher rates to minority borrowers, and unfairly targeting vulnerable communities. Consumer advocates accused the bank of using hidden fees, aggressive collection tactics, and deceptive credit card practices. In one instance, regulators fined a bank for illegally repossessing cars from members of the U.S. military, a scandal that drew sharp criticism and forced public apologies. Despite the fines and settlements, Bank of America's size and importance allowed it to continue forward, largely unscathed in its core operations. This raises an uncomfortable truth about modern finance. Some institutions are simply too big to fail, too powerful to dismantle, too essential to the economy to ever face existential consequences. For critics, this is the ultimate injustice. That banks like Bank of America can act recklessly, pay fines, and move on while ordinary citizens bear the brunt of their mistakes. The political influence of Bank of America has also been a subject of debate. With billions in assets and operations that touch nearly every sector of the economy, the bank wields immense lobbying power in Washington. Its executives meet with policymakers, its lawyers shape financial regulations, and its donations influence elections. Critics argue that this cozy relationship between big banks and government undermines democracy, allowing corporate interests to overshadow those of ordinary citizens. Defenders counter that such engagement is necessary for stability, given the complexity of modern finance and the risks of misregulation. What is undeniable is that Bank of America sits at the nexus of finance and politics, shaping policies that affect not only Wall Street, but also Main Street. Whether it is a debate over consumer protections, climate financing, or international sanctions, the bank's voice carries weight. When governments seek partners for massive bond issuances or infrastructure projects, Bank of America is often at the table. Its role extends beyond profit. It influences the very rules of the global economy. As the world entered the 2020s, new challenges emerged. Technology, once a tool of efficiency, has become a battlefield. Fintech startups, cryptocurrency exchanges, and decentralized finance networks challenge the dominance of traditional banks. Digital wallets like PayPal, Apple Pay, and even Bitcoin threaten to bypass the systems that banks have controlled for generations. For Bank of America, this represents both a threat and an opportunity. The bank has invested billions into digital infrastructure, artificial intelligence, and cybersecurity to maintain its edge. Its mobile app now serves tens of millions of customers, handling billions of transactions with efficiency once unimaginable, yet remains wary of the rapid rise of decentralized finance. Publicly, executives dismiss cryptocurrencies as speculative, volatile, and risky. Privately, the bank studies blockchain technology, exploring ways to integrate it into its operations without surrendering control. Then there is the issue of climate change. In recent years, Bank of America has pledged billions in financing toward green energy, sustainable infrastructure, and climate initiatives. It has marketed itself as a bank of the future, one that invests not just in profits, but in the planet. Yet environmental groups accuse it of hypocrisy, pointing to its continued financing of fossil fuel companies and pipeline projects. Once again, Bank of America finds itself walking the thin line between profit and responsibility, growth and accountability. For customers, the story is equally complex. On one hand, Bank of America offers unparalleled convenience, global reach, and financial services that touch nearly every aspect of life, from mortgages and student loans to retirement accounts and wealth management. On the other hand, it remains for many a symbol of fees, bureaucracy, and impersonal corporate power. It is both trusted and distrusted, relied upon and resented, a necessary tool and a perpetual target of criticism. Today, Bank of America represents more than just a financial institution. It embodies the contradictions of capitalism itself. It is a story of vision and innovation, dating back to Giannini's plank in the street after the San Francisco earthquake. It is also a story of greed, scandal, and the immense power of corporations in shaping society. It is loved and hated, feared and admired. And as the global economy faces new storms, geopolitical tensions, technological revolutions, and climate upheaval, Bank of America will once again find itself at the heart of a narrative. The question is not whether it will survive. History has proven that it will. The question is how it will evolve, and at what cost to the millions of people whose lives are entangled in the flows of money it controls. As the second decade of the 21st century drew to a close, Bank of America stood at a crossroads. It had survived crises, weathered scandals, paid billions in penalties, and rebuilt itself into one of the most stable institutions in the financial world. Yet stability is not permanence, and the bank's leaders understood that survival in the past was no guarantee of dominance in the future. For the forces shaping tomorrow's financial landscape are unlike anything the world has seen before. Technology, politics, and society itself are shifting at speeds that no banker of the past could have imagined. The future of money will not simply be a continuation of what came before. It will be transformed by forces already underway. One of the greatest challenges and opportunities comes from digital currencies. Governments around the world are experimenting with central bank digital currencies, electronic forms of money that may one day replace cash altogether. China has already advanced with its digital yuan, while Europe and the United States explore their own versions. If national currencies move onto digital platforms, banks like Bank of America will need to redefine their role. Will they remain intermediaries? Or will governments bypass them, delivering money directly to citizens? Cryptocurrencies add another layer of complexity. While volatile and controversial, Bitcoin, Ethereum, and other digital assets have captured the imagination of investors and technologists alike. They represent not only an alternative form of money, but also an alternative philosophy, one that challenges the very idea of centralized control. For Bank of America, these currencies are a threat to its dominance, but also an opportunity. Already, the bank has begun researching blockchain technology, exploring ways to use decentralized ledgers for faster, cheaper, and more secure transactions. But can a giant built on centralization truly embrace decentralization, or will it always resist what threatens its authority? Artificial intelligence is another force reshaping the industry. Today, millions of Bank of America customers interact daily with Erica, the bank's AI-driven virtual assistant. Erica manages budgets, tracks spending, and answers questions with efficiency once reserved for human bankers. But this is just the beginning. As AI becomes more advanced, it may one day make decisions about lending, investing, and risk management at scales far beyond human capacity. Algorithms will decide who qualify for a mortgage, which businesses receive loans, and how markets are navigated. This raises profound ethical questions. Will AI make finance fairer, eliminating human bias? Or will it encode the very inequalities that have long haunted banking hidden behind lines of code? The rise of technology companies poses yet another challenge. Apple, Google, Amazon, and countless startups have entered the financial space, offering payment systems, credit, and digital wallets. They bring sleek interfaces, massive user bases, and global reach. For younger generations, paying with a smartphone app feels more natural than visiting a branch. As these companies expand, the monopoly of traditional banks weakens. Bank of America, with its vast network of branches and employees, must constantly adapt or risk becoming obsolete in a world where finance is no longer a place, but a service embedded in every device and every transaction. Global politics will also shape the future of banking. Rising tensions between nations threaten the free flow of capital. Sanctions, trade wars, and geopolitical rivalries may fracture the global financial system into competing blocks. For a bank like Bank of America, which thrives on integration and global reach, fragmentation could be both dangerous and costly. The bank may find itself navigating a world where money flows not through a single interconnected system, but through rival networks shaped by politics as much as by economics. And then there is climate change, the defining challenge of our century. As storms intensify, seas rise, and communities face devastation, banks are being called to account. Where they lend, what they finance, and which industries they support will shape the future of the planet. Bank of America has pledged billions toward green energy, sustainable infrastructure, and carbon reduction. But critics demand more. They argue that financing fossil fuels, even as green projects expand, is hypocrisy that undermines the survival of future generations. For a bank built on profit, the balance between responsibility and return on investment is a tightrope walk with no easy answers. Amid these challenges lies an even deeper question: trust. In the end, banking is not about vaults, algorithms, or skyscrapers. It is about belief. Belief that when you deposit money, it will be there tomorrow. Belief that when you borrow, the terms will be honored. Belief that institutions act not only for themselves, but for the societies they serve. For Bank of America, rebuilding trust has been a century-long journey, from Giannini's wooden plank in San Francisco to skyscrapers and digital apps today. Whether it can carry that trust into the future is the question that will define its next 100 years. Perhaps the most striking paradox is this: the larger the bank grows, the more its fate becomes inseparable from that of the world itself. In 2008, its collapse would have shaken the global economy. Today, its influence is even greater. When Bank of America succeeds, millions benefit. When it falters, millions suffer. The institution has become not just a participant in history, but one of its architects, shaping the flow of money, power, and opportunity across the globe. As the world looks to the 2030s and beyond, the story of Bank of America is not simply the story of a bank. It is the story of modern civilization's relationship with money, power, and trust. It is a story of ambition and risk, of resilience and scandal, of survival and reinvention. From the humblest immigrant grocer to the most powerful executives on Wall Street, it is a reminder that finance is not an abstract system. It is human, shaped by choices, driven by visions, and haunted by consequences. And so the question lingers: what will the next chapter hold? Will Bank of America embrace its responsibility as a steward of global finance, or will it repeat the mistakes of the past? Will it lead in creating a fairer, greener, more inclusive economy, or will it cling to the short-term profits that have so often defined its history? The answer has not yet been written. But one thing is certain: wherever money flows, wherever power accumulates, wherever the fate of economies hangs in the balance, the name Bank of America will not be far behind. Behind the towering glass walls of Bank of America's skyscrapers lies something often forgotten in the grand scale of finance: people. For every executive signing billion-dollar deals, there are thousands of employees, customers, and communities whose lives intersect with the bank in ways both empowering and devastating. To understand the institution fully, one must not only follow its profits, but also listen to its stories. Consider the tale of Maria, a first-generation immigrant in Los Angeles during the 1980s. She worked 2 jobs to support her family and dreamed of buying a small home. Traditional lenders saw her limited English skills and modest savings as risks, but Bank of America extended her a modest mortgage. For Maria, the loan was life-changing, a chance to put down roots, to give her children stability, and to feel that the American dream was within reach. To her, the bank was not a faceless giant. It was a hand that opened a door. But there are also darker stories. In the aftermath of the 2008 housing crisis, thousands of families lost their homes to foreclosure. Among them was James, a middle-class father in Ohio. He had taken out a mortgage through Countrywide, which later became part of Bank of America. When the financial crisis hit, he lost his job, and with it his ability to pay. He applied for assistance, only to find himself caught in a maze of bureaucracy and confusion. Letters contradicted phone calls. Promises of modifications turned into eviction notices. One morning, he returned home to find his belongings piled on the curb. For James, Bank of America was not a lifeline. It was a hammer that shattered his life. Inside the bank itself, employees also lived through moments of triumph and turmoil. In the years after the Merrill Lynch acquisition, staff in both companies spoke of culture clashes, where the high-octane world of Wall Street investment banking collided with the more conservative traditions of consumer banking. Some thrived in the new environment, seizing opportunities to climb the corporate ladder. Others felt lost, displaced by the relentless pressure performed to cut costs, to maximize profit. Whistleblowers described sales quotas that pushed workers to open accounts customers didn't need, a practice eerily similar to scandals that later rocked competitors like Wells Fargo. For communities, too, the bank's presence has been both a blessing and a burden. In Charlotte, North Carolina, where Bank of America established its headquarters after the nation's bank merger, the city transformed into a financial hub. Jobs flooded in, skyscrapers rose, and Charlotte became known as the second largest banking center in America after New York. Yet critics argued that this prosperity was uneven, benefiting the wealthy and well-connected, while leaving working-class neighborhoods behind. The contradictions extend even further. In times of disaster, the bank has acted swiftly, donating millions to relief efforts, waiving fees for affected customers, and providing aid to small businesses. Yet at the same time, its name has appeared in headlines about lawsuits, discriminatory practices, and unethical behavior. It is both savior and accused villain, helper and exploiter, sometimes in the same breath. This duality reflects a deeper truth about institutions of immense size. They are too vast, too complex to be easily defined. For some, Bank of America is the partner that helped them buy their first car, fund their education, or save for retirement. For others, it is the adversary that foreclosed on their home, denied their loan, or trapped them in cycles of debt. What ties these stories together is power. The power to grant, to deny, to uplift, to destroy. Few institutions wield such power so broadly and so quietly. Decisions made in boardrooms ripple outward into millions of lives, sometimes as opportunities, sometimes as tragedies. And it is here in the human stories that the question of responsibility becomes most urgent. For what is the purpose of a bank? Is it merely to generate profits for shareholders, or is it to serve society in which it exists? Amedeo Giannini, in his time, believed deeply in the latter, that banking was a tool to uplift communities, not just enrich the elite. Whether his vision survives within the modern Bank of America is a question still debated today. As we move deeper into the 21st century, these human stories will only multiply. Technology may replace tellers with algorithms, but the consequences remain profoundly human. An automated loan decision can still decide whether a family gets a home. An algorithmic risk model can still determine whether a small business survives. A global policy decision can still decide whether a community thrives or falls into decline. Bank of America is not just balance sheets and skyscrapers. It is Maria's home, James's foreclosure, the employee under pressure, the whistleblower, the protester, the lobbyist, the policymaker. It is all of them woven into the complex, contradictory fabric of modern finance. And as long as these stories continue to unfold, so too will the saga of one of the most powerful banks in history, a saga not yet finished, and perhaps never to be. In the years after the 2008 crisis, one image became common across American cities. Protesters gathered outside Bank of America branches, waving signs, chanting slogans, and demanding accountability. The Occupy Wall Street movement, which erupted in 2011, made the bank one of its primary targets. To the movement, Bank of America was not just another corporation. It was a very embodiment of greed, corruption, and inequality in the financial system. Demonstrators accused the bank of profiting, while millions lost their homes. They denounced taxpayer bailouts that rescued financial giants, while ordinary families struggled to recover. In marches and sit-ins, chants echoed, "Banks got bailed out, we got sold out." For many, Bank of America's towering skyscrapers became physical monuments to an unfair system, symbols of society where power was concentrated in the hands of a few and pain was spread across the many. The bank responded cautiously. Executives spoke of reforms, community programs, and investments in neighborhoods. Press releases emphasized responsibility and recovery. Yet the damage to its reputation was already done. Bank of America, once born of Giannini's ideal of serving the common man, was now seen by millions as the very opposite, a fortress of privilege, protected by political connections and insulated from the consequences of its own mistakes. The political ties ran deep. During the bailout negotiations of 2008 and 2009, Bank of America was at the center of high-stakes meetings between bankers, regulators, and government officials. Secret phone calls, late-night sessions at the Federal Reserve, and tense negotiations in Washington determined not only the fate of the bank, but the stability of the global financial system. Records later revealed the extraordinary pressure government leaders placed on Bank of America to acquire Merrill Lynch, even as losses at the investment bank ballooned. Some accused regulators of forcing Bank of America into a deal that nearly broke it. Others argued the bank had played its hand shrewdly, securing billions in aid to offset the risks. What is clear is that politics and banking became inseparable in those years. When a bank reaches a certain size, its survival is no longer a private matter. It becomes a question of national security, economic stability, even geopolitical balance. Bank of America had crossed that threshold. It was now not just a company, but an institution so deeply entangled in the economy that its collapse was unthinkable. But while the bank fought battles at home, it also became embroiled in controversies abroad. Internationally, Bank of America has long been a player in emerging markets, financing projects from Latin America to Asia. Some of these investments brought prosperity, building infrastructure, supporting trade, and enabling growth. Others sparked outrage. Environmental groups accused the bank of funding projects that destroyed rainforests, displaced communities, and contributed to climate change. Human rights organizations questioned its ties to governments accused of corruption or oppression. These accusations fueled a larger debate. Should banks be held accountable for the consequences of the projects they finance? If a dam funded by a loan displaces thousands of villagers, is the bank complicit? If oil pipelines financed by Wall Street contribute to environmental destruction, does responsibility lie with the financiers as much as the drillers? Bank of America found itself in the crossfire of these questions, praised for its role in development, condemned for the damage tied to its money. Meanwhile, on the domestic front, new scandals surfaced. Investigations revealed that the bank had overcharged customers for basic services, mishandled foreclosures, and even continued illegal debt collection practices long after settlements were signed. Each new headline eroded public trust, reinforcing perception of a bank that was too big to control, too complex to fully reform. And yet, despite the protests, despite the lawsuits, despite the headlines, Bank of America continued to thrive. Profits returned, stock prices rose, and shareholders reaped rewards. For critics, this was proof of the system's failure, that accountability was an illusion, and that the largest players could act with impunity. For defenders, it was evidence of resilience, that the bank had absorbed unprecedented shocks and emerged stronger, more disciplined, and better prepared for future. The paradox deepened. To many Americans, Bank of America remained the bank that foreclosed on homes, charged predatory fees, and enjoyed bailouts. To investors in global markets, it remained a cornerstone of stability, a safe harbor for capital, and a critical artery in the circulation of money worldwide. This dual identity, villain and savior, oppressor and provider, defines much of the bank's modern image. It is not simply one or the other. It is both, depending on where one stands, what one has experienced, and how one views the balance between profit and responsibility in the world of finance. And as the years rolled forward, the bank's influence did not fade. It only deepened, woven into the very structure of global finance. Wherever governments borrowed, corporations merged, or currencies shifted, Bank of America's fingerprints were present. Its reach was not just national but planetary, its decisions affecting lives across continents. Among the many crises that scarred Bank of America's image, none left as deep a wound as the Countrywide scandal. When the bank acquired Countrywide Financial in 2008, it thought it was buying growth, market share, and dominance in the mortgage sector. Instead, it inherited a ticking time bomb. Countrywide had been one of the most aggressive mortgage lenders in the years leading up to the financial crisis. It pioneered subprime lending, offering loans to borrowers with poor credit, often with little to no verification of income. Sales teams were incentivized to push products regardless of whether customers could afford them. Exotic mortgages with low introductory rates, hidden fees, and ballooning payments became common. For a time, it seemed like a miracle. Millions of Americans suddenly owned homes who never thought they could, but the foundation was rotten. When the housing bubble burst, the scale of the fraud and recklessness became undeniable. Families defaulted, foreclosures soared, and communities were devastated. By taking on Countrywide, Bank of America had taken on its liabilities and soon found itself drowning in lawsuits. Regulators accused the bank of knowingly selling toxic mortgages to investors. Whistleblowers revealed that documents had been falsified, incomes inflated, and risks concealed. What was once marketed as a golden opportunity now looked like one of the most disastrous acquisitions in corporate history. The financial toll was enormous. Over the next decade, Bank of America paid tens of billions in settlements related to Countrywide alone. One of the largest was in 2014, when the bank agreed to pay $16.65 billion to resolve claims with the Department of Justice, the biggest civil settlement with a single company in U.S. history. For critics, this was proof of the scale of damage caused by reckless lending and corporate greed. For Bank of America, it was the price of survival, a painful chapter it hoped to one day close. But Countrywide was not the only storm. The acquisition of Merrill Lynch also brought its share of controversy. In late 2008, as the financial system teetered on collapse, government officials urged Bank of America to buy Merrill Lynch, one of the nation's largest investment banks. Behind closed doors, the deal was framed as patriotic, a necessary step to stabilize the markets. Yet within weeks, Merrill's losses ballooned into the tens of billions. Shareholders cried foul, accusing Bank of America of hiding the true scale of the losses until after the merger was approved. Court cases dragged on for years. Executives were grilled before Congress. Emails and testimony revealed the intense pressure from government officials to close the deal regardless of the risks. For many, this was further evidence of the too big to fail doctrine. Banks were no longer just private companies, but arms of the state shielded from failure at all costs. The line between capitalism and government intervention had blurred, and Bank of America was at the center of it. Beyond the mortgage and merger scandals, the bank also faced accusations of systemic discrimination. Investigations revealed patterns of charging higher interest rates to Black and Latino borrowers, even when they had the same qualifications as white borrowers. Class action lawsuits accused the bank of steering minorities into subprime loans, ensuring higher profits at the cost of financial ruin for vulnerable families. While settlements were reached, the damage to the bank's reputation lingered, raising the question: had the institution that once prided itself on serving immigrants and the working class betrayed its founding principles? Other scandals followed. In 2012, Bank of America was fined for improperly repossessing cars from military service members, violating protections meant to shield those on active duty. In 2014, regulators charged the bank with manipulating foreign currency markets, joining a list of global banks accused of collusion. Even as late as 2022, the Consumer Financial Protection Bureau fined Bank of America for practices like double charging fees, withholding reward bonuses, and opening unauthorized accounts. Each case added to a narrative that the bank was not just too big to fail, but too big to fully control. Yet through it all, Bank of America endured. The fines, while massive, were dwarfed by its size and profits. The headlines, though damaging, eventually faded. Customers still deposited paychecks, swiped credit cards, and applied for loans. Investors still bought its stock, and governments still relied on its services. Like a fortress weathering storms, the bank emerged battered but standing, stronger in some ways for having survived. This resilience raises an uncomfortable question. Can a bank this large ever truly be held accountable? If billions in fines cannot bring meaningful change, if scandals fade without lasting reform, what forces, if any, can check the power of such an institution? For critics, the answer is grim. Nothing short of breaking up the bank would restore fairness to the system. For defenders, the answer is pragmatic. The scale of Bank of America is precisely what makes it essential to the global economy. The debate remains unresolved, as it has for decades, and likely will for decades more. By 2011, the anger of ordinary citizens had reached a boiling point. The wounds of the financial crisis were still raw. Millions had lost their homes, savings, and jobs. Meanwhile, the banks that fueled the collapse had not only survived, but many had returned to profitability, buoyed by government bailouts and Federal Reserve support. For the public, The contradiction was unbearable. Suffering for the many, survival for the few. It was in this climate that the Occupy Wall Street movement erupted, born in New York City's Zuccotti Park. The movement quickly spread across the nation and the world. Its slogan, "We are the 99%, captured the frustration of ordinary people who felt betrayed by an economic system tilted toward the wealthy and the powerful. And few institutions embodied that power more clearly than Bank of America. Protesters gathered outside the bank's gleaming towers in New York and Charlotte, North Carolina, where its headquarters had become a symbol of the financial elite. They carried signs condemning bailouts, denouncing foreclosures, and demanding justice for those harmed by reckless lending practices. Demonstrators staged sit-ins inside branches, chanting until they were arrested, their voices echoing in lobbies designed for quiet transactions. One particularly symbolic protest came when thousands marched through Charlotte, where Bank of America had risen from a regional institution to a global giant. The city had become known as a banking capital, its skyline dominated by towers bearing the bank's logo. For Occupy protesters, this skyline was a monument not to progress, but to inequality. They called it Wall Street South, a reminder that the financial crisis was not confined in New York, but had roots across the country. The movement also exposed the emotional toll of the crisis. Protesters told their stories outside branches. Families evicted from homes, veterans who lost savings, students drowning in debt. Many of those stories trace back to mortgages and loans tied to Bank of America. For the protesters, the bank was not just a corporation. It was the face of the system that had failed them. Bank of America, for its part, tried to weather the storm quietly. Executives avoided public clashes, while the bank emphasized its programs to help distressed borrowers and its investments in communities. It pointed to billions in relief efforts, donations, and programs designed to assist homeowners. But for many, these gestures seemed too little, too late, dwarfed by the scale of the damage. The protests also reignited debates about the role of too-big-to-fail institutions in modern society. Was it acceptable that a bank could become so large, so interconnected, that its survival was treated as a matter of national security? If taxpayers had been forced to save it, did the public have the right to demand it be broken up, restrained, or restructured? These questions echoed in city squares, in Congress, and in academic debates, but no definitive answer emerged. For Bank of America, the Occupy era was a reputational low point. Though the movement eventually lost momentum, the images of protests outside its buildings lingered. The bank had become a symbol of both the power and fragility of the financial system, a lightning rod for public anger, and a case study in the cost of unchecked ambition. Yet, once again, time played to its advantage. The headlines faded. The protests dwindled. Daily life resumed. Customers returned to branches. Paychecks continued to flow through accounts, and credit cards were swiped at millions of merchants. The outrage subsided, but the memory remained, a reminder that beneath the skyscrapers and profits, resentment still simmered. This tension between necessity and resentment defines much of Bank of America's modern role. To the markets, it is indispensable. To many citizens, it is untrustworthy. To governments, it is both a partner and a problem. It exists in a paradox. Too big to fail, too powerful to ignore, too controversial to ever fully embrace. And yet, the story did not end with Occupy Wall Street. In the years that followed, new crises, new debates, and new controversies would once again thrust Bank of America into the spotlight. A reminder that its story is never still, but always unfolding. After the protests of Occupy Wall Street faded into memory, Bank of America entered a period of cautious rebuilding. The lawsuits, fines, and scandals of the previous decade had scarred its reputation, but the institution was determined to present a new face to the world, leaner, more efficient, and more technologically advanced. One of the most visible shifts came with digital banking. As smartphones transformed daily life, Bank of America poured billions into its digital infrastructure. Branches began to close in many neighborhoods, replaced by mobile apps and online platforms. The bank's virtual assistant, Erica, became a symbol of this transformation. Millions of customers began interacting not with tellers but with algorithms, checking balances, managing budgets, and even receiving financial advice from artificial intelligence. This technological pivot was not just about convenience. it was also about survival. Fintech startups, cryptocurrency exchanges, and tech giants like Apple and Google were moving aggressively into the financial space. For the first time in decades, the dominance of banks was being challenged not by other banks, but by technology itself. Bank of America knew it had to adapt or risk irrelevance. By 2020, its digital users numbered in the tens of millions, and mobile transactions far outpaced visits to physical branches. Yet while the bank embraced innovation, controversy continued to follow. In 2020, as the COVID-19 pandemic swept across the globe, governments launched massive relief programs to support struggling businesses. Bank of America became a central player in distributing funds through the Paycheck Protection Program. Thousands of small businesses relied on the bank to process loans that meant the difference between survival and collapse. But accusations soon surfaced: delays, favoritism toward larger clients, and confusion over eligibility. For critics, it was another example of a giant bank prioritizing profit and prestige over the needs of ordinary people. The pandemic also revived memories of 2008. Once again, the government pumped trillions into the economy to stabilize markets. Once again, big banks emerged stronger, their profits recovering faster than the lives of ordinary workers. And once again, Bank of America found itself under scrutiny for the widening gap between Wall Street and Main Street. At the same time, new issues emerged. Climate change became a defining concern of the decade, and Bank of America pledged hundreds of billions towards sustainable finance, investments in renewable energy, green bonds, and carbon reduction initiatives. Press releases spoke of responsibility, of a bank committed to fighting the greatest challenge of our time. Yet environmental groups were not convinced. Reports show that Bank of America continued to fund oil pipelines, coal projects, and fossil fuel exploration. Activists accused the bank of greenwashing, promoting its clean energy projects while quietly financing industries driving climate destruction. Once again, the institution found itself walking a fine line between responsibility and profit. In 2022, regulators again put Bank of America in the spotlight. The Consumer Financial Protection Bureau fined the bank for practices such as withholding credit card rewards, charging multiple fees for the same transactions, and even opening unauthorized accounts without customer consent. The echoes of past scandals were unmistakable, reminding the public that even in the digital age, the oldest patterns of misconduct persisted. And yet, despite fines, controversies, and criticism, the bank's profits soared. Its balance sheet grew to over $3 trillion in assets. Its global footprint expanded across more than 35 countries. Its reach extended into every corner of the economy: mortgages, student loans, credit cards, wealth management, and investment banking. By nearly every measure, Bank of America remained one of the most powerful financial institutions on earth. This paradox of scandal and strength, of criticism and dominance, defines the bank in the modern era. To many, it remains a villain, a symbol of unchecked corporate power. To others, it is indispensable, a pillar of stability in a volatile world. And for most, it is simply a fact of life. The bank that processes their paychecks, hold their savings, and fund their homes. The contradictions only deepen when one considers the future. The rise of cryptocurrencies, the push for climate responsibility, the advance of artificial intelligence, and the political polarization of nations all converge on institutions like Bank of America. These forces will shape not only its destiny, but the fate of the global economy. And so the story continues, not as a closed chapter, but as a living, evolving saga. The skyscrapers still stand, the digital networks still hum, and the decisions made in its boardrooms ripple outward into the lives of millions. Bank of America has survived earthquakes, depressions, world wars, financial crises, and public outrage. The question is no longer whether it will endure. The question is how, and at what cost to the society that both depends on it and distrusts it. As the 2020s gave way to the 2030s, the world of finance entered uncharted territory. Bank of America, once rebuilt after scandal and crisis, now faced challenges not from rival banks, but from entirely new systems of money and power. Governments accelerated their experiments with central bank digital currencies, electronic money issued directly by national treasuries. In China, The digital yuan became a cornerstone of everyday life, tracking spending and shaping economic behavior with unprecedented precision. Europe moved forward with the digital euro, and in the United States, debates raged over the risks and rewards of a digital dollar. For a bank like Bank of America, the implications were staggering. If citizens could hold accounts directly with the Federal Reserve, what role would traditional banks play? Would they be reduced to intermediaries, or would they adapt and thrive in the new digital order? At the same time, decentralized finance, or DeFi, grew into a parallel system. Powered by blockchain technology, DeFi allowed people to lend, borrow, and trade without ever touching a traditional bank. The philosophy was radical. Finance without middlemen, money without banks. Some hailed it as liberation. Others saw it as chaos. Bank of America studied it closely, filing patents for blockchain systems, experimenting with tokenized assets, and searching for ways to profit without surrendering control. The struggle was clear: adapt or risk being overtaken by forces it could not command. Artificial intelligence, too, reshaped the institution. By the late 2030s, algorithms were no longer just assistants like Erica. They became decision makers, managing vast portfolios, assessing creditworthiness in milliseconds, and predicting market shifts with uncanny accuracy. Human bankers were increasingly sidelined, their judgments replaced by models trained on oceans of data. For customers, this meant efficiency and speed, but also a chilling loss of humanity. Loans were denied not by a person across a desk, but by an algorithm whose reasoning could not be explained. Critics called it the black box of finance, a future where money was governed not by trust but by code. Meanwhile, climate change imposed new pressures. Rising seas, devastating storms, and widespread wildfires disrupted economies worldwide. Insurance companies collapsed under the weight of payouts. Governments scrambled to fund adaptation. And banks like Bank of America were forced to decide: would they continue to back industries fueling the crisis, or would they fully embrace the green transition? By 2040, sustainable finance was no longer a marketing slogan, but a survival strategy. Investors demanded climate accountability, regulators imposed stricter rules, and customers chose institutions based on values as much as rates. Whether Bank of America could reinvent itself as a true leader in green finance would determine its place in a fragile new world. Geopolitics added yet another layer of complexity. The global order shifted, with power increasingly fragmented between competing blocs. Rivalries between the United States, China, and emerging powers disrupted the free flow of capital. Sanctions became weapons of war. Currencies were used as tools of diplomacy and coercion. For a global bank, navigating these fractured systems became both a risk and an opportunity. Where there was tension, there was profit to be made, but also the constant danger being caught between opposing powers. Through it all, one theme remained constant: trust. From Giannini's wooden plank in San Francisco to the skyscrapers of Charlotte, from mortgages to mobile apps, from bailouts to blockchains, the survival of Bank of America depended on whether people believed in it. Trust that their money would be safe. Trust that the institution would endure. Trust that, despite scandals, despite crises, the bank would remain standing. By the mid-21st century, Bank of America was more than a financial institution. It was an ecosystem, a digital empire intertwined with the very fabric of modern life. Its systems processed trillions each day. Its algorithms shaped the flow of global capital. Its influence stretched beyond borders, beyond governments, into the realm of the everyday decisions of billions of people. And yet, the paradox endured. For as much as it gave, it also took. For every promise of stability, there was the risk of exploitation. For every step toward progress, there was a shadow of scandal. The question was not whether Bank of America would survive. It always had and likely always would. The question was what would become: a steward of progress or a monument to power. As history marched on, one truth became clear. Wherever money flowed, wherever power accumulated, wherever the fate of nations and people intertwined, the story of Bank of America would be there, unfinished, evolving, and as contested as ever. Through more than a century of turmoil and triumph, Bank of America has stood as both a beacon and a warning. It began with a vision, One man on a street in San Francisco, lending hope to those who had none. It grew into a titan, reshaping cities, economies, and lives. It endured earthquakes, depressions, world wars, financial collapses, scandals, and protests. Each time, it emerged transformed, scarred yet stronger, criticized yet indispensable. Its story is not one of simple good or evil. It is a story of ambition and greed, of vision and responsibility, of humanity at its best and worst. Bank of America embodies the contradictions of our age: stability and fragility, progress and exploitation, trust and betrayal. It is a mirror held up to society, reflecting our values, our fears, and our failures. And as we look to the future, a world of artificial intelligence, digital currencies, and climate upheaval, the role of Bank of America will remain central. It may lead us toward innovation and resilience, or it may cling to the old patterns of power and profit. The choice, ultimately, will not be made by the institution alone, but by all of us, the citizens, the customers, the voters, the voices who decide what kind of world we wish to build. The story of Bank of America is not finished. It is still being written. In every loan approved, every investment made, every protest raised, every regulation passed. And perhaps the real question is not just what Bank of America will become, but what we will become alongside it. So what do you think? Has Bank of America been a force for good, a danger to society, or something in between? Share your thoughts in the comments. We'd love to hear your perspective. And if you enjoyed this journey through history, power, and finance, don't forget to subscribe to our channel for more documentaries that uncover the hidden stories behind the institutions shaping our world. Because the story of money is, in the end, the story of us all.